Welcome back to another episode of Elevate from Burnout to Bliss. I'm your host, Reginald Clark.
And I'm Ebony Clark.
And today we're diving into a topic that has changed more lives and built more millionaires than almost anything else in the financial world: stock ownership.
That's right. We're not talking about chasing hype or trying to hit the lottery by timing the market. We're talking about becoming an owner, because when you own the business, not just trade the stock, you put yourself in a position to build real long-term wealth.
Exactly. And today's episode is all about making stock ownership simple, practical, and doable for everyday people. No Wall Street jargon, no complicated charts, just real conversations about how businesses grow, how money works, and how you can build a portfolio you're proud of.
If you've ever felt intimidated, confused, or like investing was just for somebody else, this episode is your turning point. You're about to learn how to make your money work for you, not against you.
So buckle up, share this episode with somebody who needs that financial nudge, and let's jump into episode 13, Own the Business, How Everyday Investors Build Wealth Through Stock Ownership.
Let's do it.
All right, y'all, so here we go. We back in the studio once again, episode 13, Burnout to Bliss. And today we're talking about stock ownership, specifically owning the business. Owning the business, and we're going to talk about how everyday wealth builders build wealth through stock ownership. You know, this is one of those subjects. A lot of people, and I'm so glad today that more and more people understand and know about stocks.
Yes.
The fact
definitely.
that they exist. But what I do see is not enough people actually diving in and making stock ownership a core part of their financial picture. That's what I see. A lot of people know about them. They can give you the definition, but still we got to move that ball down the field just a little bit more. We need more people just really owning and just taking deep dives into stock ownership. All right. And so that's what we hope to do today. We want to give you some practical, real life understanding, again, of how to incorporate stock ownership into your financial picture, not as traders. So we're gonna differentiate the difference between an investor and a trader. We're going to talk about the difference. The two are not the same. Often confused. We're not going to talk about that. But as owners in human ingenuity, and where you technically buy corporate growth and building long-term wealth. That's what we're talking about today.
Yeah, because scrolling through TikTok trying to time the market is not a wealth strategy.
No, it's
not.
But
it's owning part of a great company is.
That's right.
So, Reggie, let's talk about why is owning stock so important?
Owning stock, and let me be clear, I'm talking specifically today about common stock, right? And so when people usually say the word stock, the default that they're talking about, whether they know it or not, is common stock. It's
common stock.
Yeah, but I want to be clear that we're not talking about preferred or any of those. We're talking about common stock. When you own common stock, well, let me say this first. Common stocks have traditionally provided the highest rate of return out of any asset class out there.
So explain asset classes.
So asset class, like real estate is an asset class, precious metals like gold, platinum, silver, these are all commodity, different classes of assets. Bonds, fixed income, these are all different asset classes. When you line up all the asset classes together with their rates of return, as far back as history can take it, with documented returns, the shining horse that leads the pack is common stocks. So let's understand that, all right? And the reason why is because they represent ownership in companies. Okay, when you buy a share of stock, I'm gonna go finance 101. I know probably the majority of you know this, but I don't want to take it for granted. When you buy a stock of a particular company, you are an owner of that company with all rights and privileges. Okay, and so you're actually owning that company's growth. You're owning their earnings, the dividends, and when this is amplified over time through the power of compounding, it becomes really valuable. You're owning a piece of this human ingenuity that's making this company go. That's what you're owning. And again, I'm gonna go deeper into what what comes with that ownership. But we talked about a couple of episodes ago the value of being a producer and not just a consumer.
Right.
Right. And we're gonna go heavier into this in just a second.
So what stuck out to me about what you said, which is owning the growth, dividends, the human ingenuity, all of that stuff of a company when you own a piece of stock. Imagine the number of employees that a particular company has.
Right.
So you're owning a piece of a company that may have hundreds of thousands of employees whose goal is to make that company successful.
That's the goal.
So you have 100,000 people or however many employees working for you to help make this company successful, to help make you money. You're
absolutely right. Let me throw this in here. If you look at the mission statement of any publicly traded company, you're going to see a sentence in there. I don't care what they say they do, but there's going to be a sentence that says part of their mission is to increase shareholder value. Mm-hmm. What that simply means is part of the mission of the company is to make the owners wealthier.
Right.
That's what that means.
And if you've ever been a part of a company or employed by a company, I have, that initially was a privately owned company and became public, there is a marked difference in how the company is handled before and after.
Absolutely.
After, it is about making money for the shareholders. So some of the perks that went along with being a part of a private owned company, those went away because those did not make money for the shareholders.
Exactly. Let me go a little deeper with this. Some of you all, if you all know my story, my background, while I was in college, I got started in the network marketing business. And I love every minute of it. I have no regrets because it completely changed my life. We saw a lot of success very early on. During that time, the company was Excel Communications. While we were with Excel was doing so well that they went public. Mm-hmm. They were a private company. When they were a private company, we had these outstanding compensation plans. When they went, and at that time, I didn't understand exactly what all that meant. But, we all cheered and we celebrated the day they announced they were going public. But what we did not know was everything had changed. Mm-hmm. The comp plan changed. All that stuff changed because now shareholders had to get paid first.
Because the goal changed.
The goal changed.
You can't, once a goal changes, the path to that goal has to change.
Exactly.
Or else the goal would be the same. You can't have the two different paths and it's the same goal.
Right.
Something changes.
And it changed big time, man. We had no idea what was coming. But that taught me in a very practical sense, you want to be an owner, not just a contractor, employee, or whatever the case may be. Definitely not just a consumer. But you want to be an owner of companies that's making money because I'm telling you, that's where the real wealth is.
Yep. So, and with that wealth and return comes risk.
It does.
People will take risks starting a business but won't buy a share of a good company.
Right.
And they know that company making bank.
Yeah. A lot of times you have to understand risk. And when I'm talking to clients, that's where the conversation starts on. People say, well, what's a good stock to own? What's a good stock to buy? What, bond, ETF, whatever the case may be. I slow all that down and we start talking about risk because, some people can't handle certain ups and downs. Watching a roller coaster on TV may make them dizzy, so let alone what the portfolio may do. But here's the thing, though. You have to take risk in order to get the opportunity for reward. All right? Not reward. Risk don't equal reward. It equals opportunity for reward. I'm going to pause right here. And I'm sure if you didn't hear it in the intro before it came on, I'm going to give it now. Everything I talk about today, because I am an investment advisor, this is not specific financial advice for you. This is general financial advice because because we're not sitting down talking one-on-one with you about your stuff. This is not particular advice for you to offer to buy or sell. But anyway, that being said, every conversation got to start with risk because there's a such thing, especially in our communities. We have become, although we do spend way too much money, we do save too much money too.
What? Okay.
Yeah.
So explain, because most people will not hear a financial planner say that you save too much money.
You can absolutely, listen, I'm going to say it again. You can absolutely save too much money. And here's what I mean by that. If you have more than 6 months of your income put aside in a savings account, a checking account, even a high yield money market, if it's more than 6 months there, you have saved too much money. There's no reason to have that amount of cash. Well, under normal circumstances. Now, if you're saving up for a big purchase or something, that may be different.
Right.
But I'm just saying, just normal savings. There's no reason to have that much cash not working for you. All right.
Right.
That money needs to be in a position where it can grow and compound and really have your money working for you. So when you got 2 years worth of cash sitting in a savings account, and there may be something to poke your chest out about, but when I look at it, I'm feeling a little sad for you.
Yeah.
Because I'm knowing how much let me give an example, more practical example. This year, year to date,
okay,
we're up about across the board, across most accounts, about 17% so far.
Okay.
All right, year to date. Well, you think about that. There's not a savings account out there. There's not a checking account out there. There's not a CD out there that has a 17% rate of return. You see what I'm saying? So now, all money shouldn't be at risk. That's why I said some of it. But again, you can have too much money sitting on the sidelines. And you're missing its opportunity cost. You're missing. And you can never get it back.
One of the ways that for people who aren't familiar with stocks or what stocks to purchase, one of the ways that you can kind of mitigate that risk is just by looking at the companies that do the best.
Yeah.
So there are U.S. companies that have stellar net profits.
Oh, yeah.
What the number one last year was Google. So it had the highest net income, and that was around $100 billion for 2024 fiscal year. So just in layman's terms, what that means, all the money that came in after they paid all of their bills, they still had $100 billion left.
So just think about that, you all. So one, if I'd have posed it as a trivia question, who can tell me what company in the United States had the highest net profit last year? How many of you all would have known the answer was Google? And then if I'd have followed up and said, okay, what was that net profit? It's $100 billion. Think about that. Why would you not want to own a company that after they paid everything except their taxes, they had $100 billion left over? You can own a piece of that. That's what we're talking about today. We're talking about owning a piece of these companies that's generating profits.
Number two was Apple with $90 billion in net profit. And most of it, of course, is from their products like iPhones and Macs. But $90 billion with a B.
With a B. You know how much money Apple is worth, the company? Like, you add up all the value of Apple shares. Do you know?
I don't.
$4 trillion.
Jeez Louise. So
if you could stroke a check for $4 trillion, you could buy all the shares of Apple that exist. Apple has more cash than some companies have assets. Because those iPhones that some of you all love, Team Android over here, but some of those iPhones that y'all love, I don't know what they cost to make, but I know it pales in comparison to what they.
It don't cost over $1,000 to make, and that's how much they cost.
Absolutely not. But Apple came in second, $90 billion. If you're an Apple person, you love Apple. I'm not giving you personal financial advice. What I'm saying is, if I was in love with Apple, I would own Apple stock. I don't have an Apple product, and I still own Apple stock.
Right, that's what I was about to say. Even if you're Team Android, you can have Apple stock in your portfolio.
Y'all keep buying them iPhones because I got the stock.
And number three was Berkshire Hathaway. Yeah. So Berkshire Hathaway is the company that's owned by Warren Buffett. Yeah. And Berkshire Hathaway has countless number of brands, but one of their major brands is Geico. So a lot of that profit comes from Geico Insurance. And
they came in, did you give the number?
I have not.
Okay, they came in number 3 last year, $89 billion in profits. $89 billion. So again, guys, we're talking about companies. As you look around, you say, well, man, okay, I do want to get into stock ownership. I would start with the companies that are generating the most profits. And these, we just gave you 3. There's more. Just look it up for yourself. And as a matter of fact, in a little bit, Eb's going to tell you some things to look for. But just ask yourself, what companies are making money? Start there. There's going to be less risk. And I didn't say no risk. There'll be less risk with companies that are already established, already generating profits.
And start with the try and true. Start with the products that you use every day that have always been around and probably will always be around.
Absolutely. Okay, I want to add something else in right here before we move on. I want to be sure the listeners are getting this piece right here. Common stocks, and again, this is why I want to drive this point home. Common stocks are synonymous with human ingenuity. Okay? When you buy, and again, that's the drive, that's the magic pill of common stocks. You're buying the collective effort, the hard work and innovation and intellectual property of the human capital that's driving this company's success, okay, and gives it value. The employees are what generate the revenue, create the products, the innovation. It's all about the employees that all these people working together to drive this business. How can you get a slice of that? How can you own that? Buy the stocks.
Wow.
Simple as that.
That's true. And think about how many businesses that are successful now that you wish you had a piece of when they first came out.
Right.
Because you don't know what these businesses are going to become, but they had human ingenuity as a driving force behind the business.
They had good leadership. They had a good idea, a good product, a good service, and they had the right people, the right team to say, hey, let's make this happen. Like, take Amazon. Mm-hmm. Most of us will be using Amazon over the next few months to get in gifts or whatnot. You know, Amazon first sold books.
They sure did.
You know, now they're pushing everything. You can buy a doggone fabricated house on Amazon. So, again, you if you want to own, and you should want to own, the collective brain power, sweat, equity, all of that, just buy the stocks. But I want to say something real quick, though, about when you talk about the employees, mm-hmm. right? Because we're at a point right now, a lot of people losing jobs, man. A lot of these companies are shedding, and that's another topic I could go into. A lot of companies are shedding their number of employees right now, which unfortunately is absolutely horrible. But one of the things it does, it makes the stock price go up, mm-hmm. because salaries are typically going to be the biggest line item, expense for any company. But that's not where I was going. Where I was going is, I saw the CEO of Ford this week. He mentioned that he has 5,000 positions open that he can't fill because of these are mechanical jobs that he can't fill because he says he's having a hard time finding the talent, and which led to conversations about does America have a drain on his talent pool? Mm-hmm. And it's a very interesting conversation, but I just think about all of that as it relates to, again, buying the collective effort of all these people. But just something to think about, something to talk about.
That is interesting. Oh, and you didn't mention that those are 6-figure jobs.
Oh, yeah. And he did say all those jobs are 6-figure, 5,000 openings, 6-figure jobs. So, it really reminded me, because I love history so much, of all the blood, sweat, toil, everything that went into the industrial age, mm-hmm. Where these factories were able to convert over to making war machines and then back to factories, and all this innovation just kept happening all those years. America became so wealthy, which that wealth was from the agricultural age, mm-hmm. built off of the backs of enslaved people. But now we're at a point now where it would appear that some of this talent pool is missing. Of course, that's what they're saying. So I don't know. I can't really give great insight on that, but I'm just telling you this is what's out there. But I do know, now I know this from a practical standpoint, that there is opportunity in the trades. I know that's there because I'm in that space, that real estate investing space, and I see what we don't have, at least in our local market.
Right.
So I know there's opportunity there. But anyway, we actually coming up on this first break right now. So, guys, I tell you what, stay with us through this break. When we come back, we're going to be talking about the difference between being an investor and a trader and a lot of other good stuff that you want to take advantage of to build wealth through stock ownership. Stay with us. We'll be right back. Remember, it's time to elevate.
And we're back. You're listening to the Elevate Podcast with Reggie and Ebony. And Reggie, in the first segment, we talked about why you should own stock.
Right.
But before y'all run out and go buy stuff, you need to know what your risk tolerance is. Like,
that's right.
How much can you handle?
Right. Understand, again, I mentioned in the first segment that understanding risk, specifically your risk, mm-hmm. not what your friend told you to buy, or not what you heard at the doctor's office. Understanding your risk is your starting point.
Because you got to be able to sleep at night.
You got to be able to sleep at night. And you need to know what amount of money, what level of risk you're comfortable taking, what amount of your money you're comfortable putting at risk. And it's a lot of questionnaires out there. We use just 7 questions here at the office, very quick, to determine what a person's risk tolerance is. But the whichever one you use, again, you can find some online. The idea is to figure out whether or not you're a conservative investor, moderate, or aggressive, and there's a couple of slices in between. And the whole thing is that based on where your risk tolerance is, that's going to determine how your portfolio rather, is put together. Because what you're going to find, if we get time, I don't know, hopefully we'll get time to talk about the fixed income side a little bit, if we have time. But what you're going to find is that different asset classes in your portfolio respond differently under certain market conditions. So when you put a well-constructed portfolio together based on your risk tolerance, mm-hmm. it should give you what you're looking for over time. Right. It'll give you what you're looking for. So, for instance, if you're really, let me be more practical. If you're really aggressive, then you probably wouldn't want to go out and buy, or you wouldn't want to make, to fulfill your aggressive desire, you shouldn't buy Coca-Cola stock. Reason being, not that it's not a great stock, because it is, but it's a big established company. We wouldn't expect Coke to get much bigger than it already is. We would buy Coke because we want the dividends. We want the income from Coke. Or if you're looking for a dividend stock or something that's going to pay you a consistent income, a high income, you wouldn't want to go out and buy, say, NVIDIA. I think NVIDIA may pay a dividend right now, but it's going to be really small because that's a growth company.
They're trying to grow. So their money is being reinvested back into the company.
They're retaining their earnings to make the company bigger. So you got, or another good dividend stock is Verizon. You know, I wouldn't buy Verizon because I'm hoping it's going to go from 40-something to 80.
Right.
It's probably not going to happen in the short run, long run either. But it's a great dividend play. Okay, so again, knowing where you are in that spectrum will guide what you need to be purchasing or what you should be thinking about purchasing.
Right. And I want everyone to keep in mind and just remember that we're talking about ownership. So there's a difference between trading stock and owning stock. So trading stock is like speed dating. Right. Owning stock is building a relationship with that company. So, and I know on my timeline, on y'all's timeline, you probably see people talking about, I made $8,000 today and just trading these 3 stocks. That's different. So that is timing the market. That is less about the company itself and more about trying to get in at the right time and out at the right time. So this is not what we're talking about today. We're talking about buying stock and retaining it, holding it.
Absolutely. I agree 100%. And I say this, it's absolutely nothing wrong with being a stock trader. That's just not what we're talking about today. Because a trader watches charts. An investor watches companies. And there's a difference. So what we're talking about today is identifying good companies to own and hold for the long haul. You know, I heard Warren Buffett say one time, when he purchases a company through Berkshire Hathaway, he's buying shares of that company with the intention of making money over the next 10 years, even if the stock market closes.
Got it.
So he's not buying it because he wants to buy low and sell high. He's buying it because of the income he's going to receive, the cash flow he's going to receive from being an owner of that company. And that's the difference, again, of being a trader versus an investor. So that's what we're talking about today. Okay, so yeah, like I'm saying, we talking about being investors, long-term investors. So here's the thing. Let's move the conversation down the road. Let's help the listeners to, where do they start? What is it that they're looking for in picking stocks with as little guesswork as possible? Because and I'm gonna tell y'all something now. You never will really take all the guesswork out of buying a stock, because here's one thing I want you to remember. Whatever point you think is a good price to buy a stock, there's someone on the other side thinking it's a great time to sell.
Right.
So if everybody was right, then the stock market would never move, okay? But anyway, Ebony, where should a person start in just their initial search or what have you?
So the very first thing, as I mentioned, is starting with companies that you're familiar with and that you know. So you need to know what they sell. Okay. Like, don't just look at a chart and see something and they were up 50% yesterday and you go for that. Like, start with knowing what the company actually does. What is their business? Then once you determine that, let's look at some financial statements. And I know you're thinking, okay, I don't even know what to look for on the financial statement. Right. So for a non-financial person, look at growth, consistency, stability, look at their profitability. So it's easy. If you go to their website, you can pull up their financial statements and just look. It's numbers. So hold on,
because I want to be sure everybody get it. You go to the website, but then you got to click. There's always a little thing that it says investor information, investor relations, or something like that. Okay. Click on that. Okay. Now go.
And look at the number. So the net profit number, was it 10? And that can be 10 whatever this year. Or 2 years ago it was 10. The next year is 15. That's showing growth. Like, you don't have to understand all of the inner workings of it. And then,
so hold on again. We got to keep it simple. We got to keep it simple so I can understand. So we're clicking on that investor tab. And which financial statement do we find this net profit thing on?
It's called a profit and loss statement.
Okay.
Or an income statement.
Okay, so guys, go to the Investor Relation tab on whatever company you're interested in. Find which statement?
Income statement.
Find the income statement. Go down to the line that says what?
Net profit.
Net profit. And you should be able to look back a couple of years, right? Mm-hmm. And see if that number is higher the last year is there than it was the year before.
Right.
And the year before.
Right.
And so if those numbers, like if that line, that one line, you got to understand everything else. But if that one line is getting bigger, that number is getting bigger, then you know this company is trending upward in its net profits.
Correct.
Okay, good.
So another statement that you can look for is the cash flow statement.
Okay, now what is that going to tell us?
So that tells us how much cash they actually have.
Okay.
So profit is one thing, but profit doesn't necessarily equal cash.
Okay.
So you don't want a company, if they're profitable, but all of their money is, it's like
a building or something.
Purchasing a building where it's the asset or something like that, that you need to look at how much cash do they actually have.
Got it.
So you want to marry profit and cash.
Okay.
Because the company can also have cash because they have a lot of debt. So if they got a loan but received a lot of cash from the loan, the cash flow statement may show that they have a lot of cash, but the profit and loss statement may show that they don't have much profit. So you want to look at those two things together.
Got it.
And then you also want to look at the balance sheet. So the balance sheet shows everything that they own, like a value for everything that the company owns, and then a value for everything that the company owes.
Okay.
So it'll show how much cash in the bank. It'll show how much all of their equipment is worth. It'll show how much all their buildings, land, all of those things are worth. And then, but it'll also show all of the debt that they have.
Okay.
So look at these three statements like you would evaluate your own finances.
Right.
So if you're talking about your own finances, you will want to have money left over at the end of the month or at the end of the year. You will want to own a lot of things but have little debt. And you will make sure you had some cash in the bank.
Yeah.
Use those same three criteria when you're evaluating a company.
That makes a lot of sense. And you made it so simple. You know, I'll say this, guys. There are companies out there that you can pay that have already read these statements. They just give you a recommendation to buy the stock, sell it, or hold it. And some of them are really good. So some of the companies are good that do this. But I want to encourage you all to, it's kind of like I do with real estate investors who, when they first getting started and they say, okay, do you have a good property manager? I always encourage people, manage your first one yourself. And then once you know, because you need to understand what the property manager is doing. Are they doing a good job? You need to understand it. So I would say, you know, if this is not your strong suit, you don't have to become a master at this. But I would say make it a goal, maybe a 2026 goal, to increase your financial understanding of just the three statements Ebony gave you. We had a guest on the show, Monica Genius. Reach out to her.
Right.
Pay her a consulting fee. She will teach you how to understand these statements. And again, not to the point where you're going to go into accounting or financial analysis, but to the point where you can read them well enough where you can say, this is a company I'd like to own.
And you can go back and listen to the episode where she was a guest. It's part of season 1. So you can find that on YouTube.
No, she was a guest this season.
Was this season?
Yeah, she was a guest this season.
Okay, season 2.
Yeah, she was.
It's been a long season.
It's been a long season. Yeah, she was a guest. Yeah, so go out to the YouTube page, find the one that says Monica Genius, and you know she's a great resource for understanding
excellent resource
financial statements and things of that nature.
So we just finished talking about what investors use to pick stocks, and we're not really talking about trading today. But what do traders use to pick stocks? Yeah, so stock traders are not interested in any of the things we just talked about. They don't care nothing about that. Stock traders are using, a lot of them use the candlestick charts, and it's just a chart that shows, it's a visual representation of the price movements up and down. It just shows them very quickly where the stock opened at, where it closed, and it shows the trend. Is it a bullish trend, meaning is it going up, bearish trend going down? They can get a very quick synopsis so they can make a game time decision. They want to buy, sell, or hold a stock. And so where would they find the candlestick charts?
They can. There's plenty of software out there that got the candlestick charts. You can to get the real good charts, you need to pay for that information. There's some places where it's free, but you really need to pay for that information.
Got it. Okay.
Yep.
Now, candlesticks are cute, but unless you're trying to be a day trading ninja, stay focused on owning companies long term.
Exactly. And, earlier we talked a little bit about, Ebony mentioned product affinity. And I want to tie this back again to a previous episode. The episode we did, can't remember the title of the episode, but the episode where we were talking about being a producer versus a consumer. Do you remember the title of the episode? Just a couple of weeks ago. Anyway, I want to tie it back to that. And that is because not only do we like our brands, we often have the ability to choose which brands are cool in the marketplace. We talked about that before. What I want to say is, if you're going to use your personal influence, and I'm not talking about you got to have 100,000 followers. If you're telling your friends, your family about a particular brand you like, please just own it, right? Don't just encourage people to go out and buy those shoes because you like those. Own them shoes,
right?
Okay, so the product affinity, again, if you just loyal to Ford line, own Ford. If you loyal to you in and out of Family Dollar 3-4 times a week, own Family Dollar.
Yeah.
That's what I'm saying. So that way, again, you are being a producer and not just a consumer, because we have these affinities to certain products, and that's just human nature. But we're trying to get you into a mindset of owning the companies you do business with.
And let's cut down on the guessing, because there's always going to be that cousin at the cookout that swear they know what the next big thing is, and it's just based on a feeling that they have, and they can't even explain what the company does. So let's use these strategies and actually make a educated decision on what we should purchase.
Right. We don't want to purchase based solely off feelings, man. All right, that's not what we want to do. So one thing in the few minutes we got left in this segment, I want to talk about what actually drives a stock's value. What is it that really gives a stock value? And I'm going to tell you, pure and simple, it's earnings, all right? It's cash flow. If a company is making money, then that's going to give us its earnings. That's what you're looking for, companies that are making money. Because a stock, sometimes people think a stock, the whole idea is to buy the stock so you can buy low, sell high. That does not determine its value. That's really playing financial musical chairs, and that's kind of some of the issue I have a little bit with the digital currency space, is because the whole idea you can't get dividends from anything like that. You're just buying it, hoping somebody's going to pay you more than what you pay for it. A stock's value is derived from the cash flow it actually generates. Okay, so don't forget that. So actually, in the last minute of this segment, although today is about stock ownership, I am going to educate a few of you all that may not know exactly what a bond is.
Okay.
So whereas a stock represents ownership in a company, a bond actually represents debt to a company. Okay. So when you buy a bond, if it's a corporate bond, a bond from a company, you're literally loaning that company money, right? And then that company is stated on the bond. They're going to pay you interest twice a year, or however oftentimes typically it's twice a year. It is stated what interest rate they're going to pay you back. And at the end of the time period, they're going to give you back to pay you back the principal. And that's all a bond is. So people, stocks and bonds, stocks ownership, one, you're buying a piece of the company. A bond, you're literally loaning that company money. And I'll add this too. You not only can buy bonds, you can't buy stock in a city or local government or the state, but you can loan money to your local government. You can loan money to the state. You can loan money to the federal government. Matter of fact, it's probably the biggest debtor there is, federal government. But you're just buying municipal bonds or federal bonds. But whenever you buy a bond, you're loaning that entity money. That's all it is.
And let's add mutual funds, because usually people say stocks, bonds, mutual funds.
So real quick, what a mutual fund is a collection. It's my money, your money, everybody's money in this big gigantic pot. And there's a manager, typically a team of people, who they make the decision. You don't own the stocks directly. If you got a mutual fund or ETF, you own a piece of the pot. The managers decide which stocks, bonds, whatever they're going to buy with the pot of money. So you own a piece of the pot. The pot itself or the fund owns the individual stocks. All right, so that's the difference. Whereas earlier we were talking about buying a stock where you have direct ownership. If it's in a mutual fund, your money is pooled with a whole lot of other people, and you own a share of that pool. and the pool itself owns the individual stocks. All right.
And ETFs are similar to mutual funds.
ETFs very similar to mutual funds. They just trade like stocks. Okay. So guys, stay with us through this last break. We'll be right back. We're going to come back, and when we come back this time, we're going to be talking about how to start owning businesses today. So we've been talking about what it is, why it is. Let's talk about how do you actually get going. All right. Stay with us. We'll be right back. Remember, it's time to elevate.
This episode of the Elevate Podcast is brought to you by P3 Wealth Management, a registered investment advisory firm registered in the state of Tennessee. Whether you're investing, preparing for retirement, or creating a lasting legacy, our team is here to guide you every step of the way. At P3 Wealth Management, we turn your financial goals into a strategy so you can focus on living the life you worked hard for. Visit p3wealth.com to schedule your consultation today or call us at 901-209-4015. That's p3wealth.com. Plan, protect, and prosper.
And we are back. So you're back for this final segment of episode 13, season 2 of the Elevate Podcast, where today we've been talking about own the business and how everyday investors build wealth through stock ownership. So what we're going to talk about right now is how exactly do you start buying these stocks? How do you start building this wealth? Mm-hmm. Well, I want to make it as simple as possible. I know sometimes people try to use all this jargon, this language to make it as complicated as possible, but it's really not, guys. So the first thing you need, you can do it a couple of different ways. Let me just make it really easy. First of all, if you have a 401k or a corporate sponsored plan, then if there's going to be mutual funds in there, that's a really simple way. You should be participating, especially if you got a match. Sometimes so many people like, no, I'm not going to do it. I'm encouraging you to do it up to the match, whatever the match is. Participate, because for some people that's as close as you're going to get to being an investor, and there's nothing wrong with that. There's nothing wrong with that, but don't sit it out, because I'm telling you, those few dollars that come out of your check, you'll find a way to make up for it. It's just somehow you'll make it. So that's one way. But outside of that, and I do encourage you to have something going on outside of that, you're going to want to open up what's called a brokerage account. Not hard to do. You get with, obviously we do it here, but it doesn't have to be with us. You can open it up on your own. You don't need an advisor. You may want one, but you don't. You can do it yourself. You can do it through a Ameritrade. Well, Schwab bought a Ameritrade. Through Schwab, you can do Merrill Lynch. You can do Robinhood. It doesn't matter.
There's so many ways now. Technology makes it super simple. I think even Cash App has an option to trade stocks. So.
Exactly. So just get you a brokerage account outside of the job. Okay?
Just get started if you haven't already.
If you haven't already, just get started. And then now, at the last segment, we talked about the difference between buying individual stocks, which we spent a lot of time on first segment. And we talked about starting with companies and then Ed brought up ETFs. We kind of talked about mutual funds. ETFs are very similar to mutual funds. They just trade like stocks. I don't want to get too deep into the weeds, but I will tell you I prefer ETFs over mutual funds for a lot of different reasons. But there are some funds that I use. Go ahead, Ed.
And the main thing is mindset shift.
Absolutely.
From being a consumer to being an owner. And
yes.
Again, a lot of these topics, you can go back and we have whole podcast episodes on that specific topic.
Right.
But just figure out, in addition to owning the product, let's own the company. If you're going to spend $300 on the shoes, let's also spend $300 on the stock. Or if you only have $300 to spend, $150 on the shoes, $150 on the stock. Just get started is the main thing.
Just get started. And this is such an appropriate conversation to be having just a few weeks out from Christmas, where there will be a lot of consumer purchases on things that won't be around by late February. But I love what you just said. If you plan to spend $500, why not on a particular child, person, what have you, why not buy that person some stock? Why not give them something and teach them, like, this is something that's going to be around long after that shirt I was going to get you, or whatever the case may be.
And you can print it out and put it under the tree, too, and explain to them how important that is and what that means. And I promise you, it'll have a similar effect. It
will. I put up a post earlier this week, last week now. I put up a post, and I was talking about this whole deal with the 50-year mortgage. I want to insert this right here. And I won't rehash the whole thing. You can go out to my Facebook page and you'll see the video. Facebook, Instagram, or TikTok. It's on there. But anyway, I was talking about this whole idea of the 50-year mortgage. And what I brought up was that the difference between the 50 and the 30-year, if you were to invest that over time, I ran the numbers, you can pay it off in a fraction of the time, like 20 years. Well, a few people mentioned that most people aren't disciplined enough to do that.
Okay.
And I won't argue that point, but what I will offer is, here's where you can combat being not disciplined, is through automation.
Yes.
Okay? So what I mean by that is, automate. I'm encouraging everybody. I do it myself. Automate your investments every month. Those transfer, because you're not spending that money. You're simply transferring it from your bank account over to your investment account. Do it automatically, so we can take the decision out of it. You make the decision one time, and then it's just automated. I don't care if it's $200, $300, $400 a month, whatever it is. Just automate that, and then we don't have to rely so much on your personal discipline. Treat it like a bill. And it's so funny to me how we can normalize a $600 car note per month. But then when I say, well, why don't you put $600 a month in your stock portfolio? Now all of a sudden that number sounds big.
Right.
So how can it not sound big when you're paying somebody else, but it sounds humongous when you're paying yourself?
Right. Something big that's going to depreciate when the stock account most likely is going to appreciate.
Exactly. We're talking about a mindset shift. So make it, it's not big. If it wasn't big for them, it shouldn't be big for you. All right.
So when people watch the stock market, you may go to CNBC or MSNBC and you see the stock prices go up and down. So most people think, okay, I have to buy low and sell high in order to make this whole stock investment thing work. But you can also make money in a down market. So can you tell them more about that?
Yeah, you can make money no matter which way the stock market is going, up, down, or sideways. You can make money. So, well, first of all, let me say this. And again, without just being too technical, the best time to buy is when the market's going down, right? Because you're not buying at the higher prices. So you got to pull back like we experienced on Friday, like we experienced on Thursday, really Wednesday too, now I think about it. When the market is pulling back, meaning it's starting to go down, that's the best time to introduce new money to the system. And you don't want to get into market timing because typically you're not going to win. But when you see it, if it's staring you right in the face, we got a 2 or 3 day pullback, that's usually the better time to put money into the market. Now, that being said, how do you make money when the market's going down? You can do a thing, and I don't know what you're looking for, but this answer I'm going to give. You can do something called shorting a stock, which means you're actually betting against the stock going up. And I won't get too technical, but you can short a stock. Write it down, SHORT. You can short the stock, and if your hunch is right and that stock goes down, you will make money while the stock is going down. Please listen to me. Understand the risk associated with this, all right? Educate yourself on what shorting the stock is, because if it takes off the other way, you will lose money. You will lose money. So you gotta know what you're doing. But I'm gonna tell you, man, I don't know what I was thinking, but the stock I wish I had shorted when there was a movement last year or whenever it was to not shop at Target. Man, I should have been thinking. I'm like, I don't know why I didn't short that stock at the same time that went out. And man, anyway, I continue to kick myself in the butt because really, I'm like, man, if this is successful, they're going to lose market value, and they did. And so by betting against it, we
a lot of market value.
Yeah, man. But anyway, just know, again, and we're talking about, now that's not a strategy you want to start out with day one, how to short stocks.
And you probably need some advising on that. Like that's a more advanced strategy, but we did want to let you know that you can still make money in a down market.
You absolutely can. So again, you don't want to start out with that, but educate yourself and just put you and your family on the path of being more financially literate. And just here a little, there a little, and you'll start to pick up things, and you'll find that you're light years ahead of where you once were.
And you mentioned you and your family involved. If you have kids, involve grown or young, minor kids, involve them, help them pick out stock, or help them come up with the stocks that you all should buy as a family.
I want to wrap this episode up as being just giving just practical steps of things you can do to start today. Well, tomorrow when the market opens, right? Well, no, some you can start today, and then tomorrow when the market opens back up. So if you're in, well, I don't know where you're listening to this at, but we're in the Central Time Zone where we're recording from, broadcasting from. It's for us, it's 8:30 to 3 o'clock. Is when the market's open. But anyway, the first thing, if y'all remember, here's a pop quiz. What do we say the first conversation around stock ownership is going to start? The answer is risk, assessing your risk. So there are free online questionnaires. You reach out to us, I'll email you one. It's, again, 7 questions, and you can score it yourself. You'll see exactly where you fall as far as being conservative, moderate, or aggressive. But that's going to be your first step of moving down the path of stock ownership.
Yeah. And then just go ahead and open that account.
Yeah.
So figure out where you want to open the account. And again, don't do no analysis paralysis. Just pick a company and do it.
Right.
And then you can start small.
You know what? A question. I'm going to tell you a question someone is having right now. How much do I need to start with? How much do I need to start with? Let me answer that question. How much you need to start with is going to depend on your finances, obviously, and also the particular platform or company that you open the account with. They may have minimum account sizes. Okay, so I think, and I don't have that information in front of me, so you just have to look and see what's the minimum account size that you can start with. And I can tell you there's no maximum. I can promise you. None of them have a maximum. But there'll be a minimum that they'll say, okay, you have to. And it can be as low as, I've seen some as low as $500. I've seen some $1,000. So there are ways, again, to get going without having to bring, $1 million to the table.
And then once you narrow down some stocks, look at the profitability. So did they make more money last year than they did in the years prior? Look at cash flow. How much money do they have in the bank?
Hold on. And where are they looking at these things? Where are they finding these?
The profit and loss statement or income statement
right.
and the cash flow statement. Look at their debt levels. You'll see that on the balance sheet. And then make a determination after that. Well,
I want to throw something else in there, too. Look at who's running the company. Look at the leadership. If it's an idiot at the helm, this person got a track record of destroying companies, then maybe if he or she destroyed the previous 5 companies, maybe you don't want to invest in number 6.
Right.
All right. Because I'm going to tell you, man, a lot of these people at these C-suite levels like this, when they're booted out, trust me, they land on their feet.
They do.
And they get picked up real quick.
With another company.
Yep. Somewhere else to do it all over again. And I'm looking at it like, man, let that have been a rank and file employee that screwed up like that. They don't get another shot at it like that, But so anyway, look at the track record of who's calling the shots, and let's see if this person has a track record of being profitable and turning companies into successes.
Then, if you're a new investor, go ahead and make your first purchase. Do it consistently, and then automate the purchases if you can.
Right. And by automate, I mean what she's saying is set up a time every month where you're just going to treat it like a bill if that helps. I want you to grow past that. But if that helps, treat it like a bill where you're saying, you know what, I'm going to set it up where it's just automatically every time, like clockwork, same time every month, is going to go from my checking account over to my investment account.
And then remember, ownership is a marathon. So the chances are going to be slim that you're going to purchase something today and then wake up tomorrow. And if you're not already a millionaire, then all of a sudden you're a millionaire. I mean, that's like finding a needle in a haystack. So just know that this is something that you're going to do over time to build wealth.
That's right. Stop trying to get rich fast. Even the scripture talks about that. Get that out your mind that this is, because when we're talking about stock ownership, we're not talking about gambling. We're not talking about doing any of that sort of thing. We're talking about owning a piece of wealth-building machines that can definitely change a lot for you and your family.
So today wasn't about making you a stock genius. It was about helping you step into the mindset of an owner. It starts in the mind. It
starts in the mind. Owners, man, we eat different. Owners think different. And when you start owning companies you believe in, that's when you really, really start to build wealth. I wish there was a button I could hit where I could just download the thought processes of an owner into your head. But when you look at it from when you do start to make this shift, you will start to see a lot of things differently. Really, life just starts to look different. But anyway, I'm trying to help you develop as best we can the mindset of an owner. All right.
And this is an aside. So community is important to me. Mm-hmm. And it is very important that my community does well. So if you are already of this mindset, then go out and share that with somebody else. Yeah. Because we only can know what we know. It's impossible to know something that you've absolutely never been exposed to. Mm-hmm. So just drop nuggets along the way for somebody else to help out somebody else in your community.
I want to share this real quick. I think I got time. I want to share. You said about sharing what you know. I can remember a few years back, we got a new client, did some business with a gentleman, still our client today. And he mentioned to me that he has some friends who all do very well financially. And I was like, hey, I'd love to meet them, love to talk about what I do, see if we can, do business with them as well. Mm-hmm. He said, no, they got to get their own advisor. No.
Oh.
I'm like, man.
I mean, it don't take away from your time.
Yeah, but no, he was like, basically, he was very pleased with our services, but he wanted me to be his best kept secret.
I know, I'm saying, but it's not like you have a finite amount of time to spend, and once, if 5 more people are your clients, then that person gets less.
Yeah, that's not how you looked at it, man. So y'all, when you share what you know, pass it along. Let's elevate us. Let's lift as we climb and elevate as we go.
Rising tide lifts all ships.
Lifts all ships, man. So, give them my sign off. So we got to get out of y'all way.
Yeah. So you can reach us at the office 901-209-4015. I'm on social media at Eb the Advisor, EBTHEADVISOR.
And like Eb said, same phone number, of course, for me. But you can also catch me at The Money Jedi on Facebook, Instagram, and TikTok. I do some stuff on all of them. But main thing, guys, we hoping that we pushing information that's taking your life from where you are to where you're trying to get to. Best way to catch us really is by giving us a phone call.
Yeah. And then you can, if you want to look at past or listen to past podcasts, we're on YouTube at Elevate Now Podcast. But that's episode 13 of Elevate. Be sure to share this with somebody and keep this conversation going about owning.
Let's keep it going, y'all. Remember, y'all, it's time to elevate.
Real estate investors, the year's almost over, but your tax strategy shouldn't be. At P3 Financial Group, we specialize in helping investors make smart moves before December 31st. From maximizing depreciation and write-off to structuring your entities the right way, we'll help you keep more of what you earn. Don't just file taxes, plan them. Call P3 Financial Group today or visit p3financialgroup.com to schedule your year-end strategy session.